Want help to grow your business? Download Bryn, the world's first business advisor in your pocket. To find out more, visit bryn.ai or search the App Store today.
Hi, I'm Dale Beaumont and welcome to Secrets Exposed. And in this episode, we're going to talk about how to raise capital to fund business growth. That coming up in just a moment. Our special guest today is a serial entrepreneur, someone that's created 7 businesses, and today she's the co-founder of Workable. And we're going to be talking about how to raise capital to fund business growth. Now, we've got a 45-minute interview planned, and that means we're going to go into a deep dive into this particular subject. And I've talked to lots of entrepreneurs in preparation for this interview, many of them that are looking to raise capital. And these are the definitive kind of 15 to 20 questions around this subject. I can't wait to get started. So let's get underway. Fiona, thanks for joining us.
Thank you very much for having me.
All right, so let's quickly bring everybody up to speed. What is capital raising and what does it mean in terms of business?
Okay, so capital raising is about putting money or finding money to put into your business. It could be to start your business or it could be to grow your business. And there's a dozen different ways that you can raise capital. It could be anything from using the savings that you have and putting them into your company or into your business. It could be going out to what we call the triple F group, which is friends, family and fools, and getting a bit of money from them to start or grow your business. It could be going to the bank and getting a bank loan, putting that into the business, or it could be going out to what we call angel investors or venture capital firms when you get to bigger amounts and getting the capital there to put into your business to kind of move it forward.
Okay, fantastic. Let's talk about some of the benefits about why it would be good for a business to raise capital.
Sure. Well, first of all, it's expensive to run a business. I think everybody out there in business land would understand that. And sometimes businesses take a little bit of time to get off the ground. So one of the pros of raising capital is that you've got a bit of a stockpile in the bank to be able to use that for things like marketing. It could be for things like equipment. If you're starting a manufacturing business and you need to buy big machines, then having the capital to be able to do that means that you can hit the ground running faster. It could be even just throwing it at different campaigns that you want to do to get the business off the ground. Alternatively, it could be just to help you catapult to the next level is why you need some money in the bank to kind of really push things forward.
And they say there's no such thing as a free lunch, so
Yep.
obviously there's some drawbacks with this strategy as well.
Yep.
What are some of those?
Well, I think depending on where you get the money from, so if you go and get it from the bank, obviously you've got a loan that you've got to service, so you've got interest payments and regular outgoings that you have to meet, typically from the cash flow of the business. If you're going out to third parties, then it could be that you either have a loan with them or you actually give them a stake of the business. Now, if that's the case, what it means to you is that you lose part of the ownership of your business. So if if your business is worth $1 million and you go and raise $100,000, you may have to give away 10% of your business to other people who then have a share in your business.
Okay, and next question I got, what are some of the other benefits that are non kind of monetary in terms of raising capital?
Yeah, well, look, I'm a really big advocate of smart money. So we have raised money for our business a number of times, and we always are very careful about the people that we get that money from. So some of the other benefits you get alongside the money is the connections that those people have. So if you can get smart money into the business, that is people that come with other benefits. It could be they can introduce you to customers that you're trying to get into. They can introduce you to other investors. They can introduce you to other influencers or experts that can help you take your business to the next level. So it could be strategic people, it could be marketing people, it could be media people that they can introduce you to. It could be that they have some expertise that you can use. So they may have driven 3 or 4 businesses to success. They can then come and apply that to you and become advisors to you. Not every person that you raise money from will be instrumental in running your business, but people that come with those sorts of smarts that are good enough to kind of leave you to it most of the time, but that can come in and help you when you need it is really, really beneficial.
And does capital raising kind of is it better suited to some different types of businesses as opposed to others? Oftentimes you hear about tech companies raising capital, all the time.
Yeah.
But if you had like maybe some dry cleaning businesses, or you maybe ran like a coaching practice,
Yep.
is it relevant for you?
Look, It can be relevant for anyone. It's not necessarily the type of business, it's the potential that the business has. So the more potential your business has, the easier it's going to be for you to raise capital, because investors are going to be able to see the return they're going to get. So if you're the corner shop, that's going to be a little bit harder to raise money, because investors will come along and they'll say, well, you know, I can sell X number of loaves of bread, I can sell X number of bottles of milk. Am I really going to get a massive return out of that business? But if it's a business like a tech company, I mean, we all hear the stories about the big tech players like the Airbnbs of the world and the Ubers of the world who've raised huge amounts of money, but they have massive global potential, and that's what the investors are banking on. So it's not suitable for every business, but if you can find a really unique niche for your business, and it could be that you're the local dry cleaner, it could be that you're a business coach, then if you know every business or every industry has examples of businesses that have done really great things, really innovative, really disruptive things, then you have the opportunity to go out there and sell that concept to investors and have them buy into those big plans for you.
Let's talk about some of the models of capital raising. You've mentioned some of them before in terms of people having equity in the business. Other times it's just getting like a return on investment, a ROI.
Yeah.
Tell us about some of the other models, or if you want to expand on some of those a bit more.
Okay, so I think the first one is the most basic, and I'm not talking about bank finance here, I'm talking about actual money from other people. So you can do that in a number of ways. The first is to issue shares. So if you have a company that has, you may be a $2 shelf company, which a lot of mum and dad style businesses start that way, you would then typically go out and issue some more shares. So let's say you have 100 shares in your business, you might sell 10% of those shares to your investors in exchange for their investment in your company. So they have 10% of the company, you have 90% of the company, everybody's on a even playing field. If you then go out and do another raise, everybody dilutes their shares in proportion to whatever money is coming in. So that's the easiest one to deal with. The next is what's called a convertible note. So a convertible note is like a loan, where somebody will say, look, I think, Dale, what you're doing is a really good thing. I want to give you 100,000, but I'm going to loan it to you for now, which means it is repayable to me. Now, that may be with interest, or it may be interest that's accumulated, so you only pay the interest at the end, or it could be no interest. But a convertible note is when I will then say, look, I've then got the option of converting that into shares at some point, and it's, as the investor, it's my option to do that. So if I can see that your business is going to take off, I want the option to say in 12 months' time, you know what, that loan I gave you, I now want it as shares. That's called a convertible note. How
soon would they want the money back?
Look, it could be 12 months.
Yep.
It could be 4 years. It depends on what you can negotiate with the investors. I've seen them as low as 12 months, and I've seen them as long as 2 or 3 years is probably the longest.
And are those loans oftentimes secured against a home or other assets, or what happens if the company...
Not usually with a convertible note.
Right.
They're secured against the company. But again, these deals come in all shapes and sizes.
Yes.
So it really depends on the business and the investor as how you, the business and the investor as to how you structure a deal. It's a bit of a how long is a piece of string question. Every investor will come to you with a different proposal. They may have done other investments. They've done them as convertible notes. They understand that. They want to do it the same way again.
And should you as the business owner be kind of leading the discussions and presenting the options? Is it sort of more of a dance, or is that the investor directing you about what they want? How do you kind of...
It's a dance.
Yeah.
It really is a dance, especially for the first round. So when this is the first time you've ever done it, you don't have a lot of collateral.
Yes.
You've got you and your business, and especially if you need the money, the more you need the money, the less power you have. So it is a little bit of a dance to find out, where everyone sits, what everyone's happy with, how desperate you are for the money. I've seen businesses sell their soul on really bad terms to get some money in the door, which I would strongly try and dissuade anyone from doing. But that first one is always a bit of a dance. Once you've got one set of investors, you then have a much stronger position to then bring the next set of investors on at the same terms. So, because you can't have different, well you can, but it's difficult to have different terms for everybody. And the first lot of investors you have may not be comfortable with the next lot of investors coming in at a more favourable deal.
Yes.
So you tend to set the playing field on that first level of investment.
Okay, considering we're talking about negotiating here, and it's very hard to negotiate if you're not in a position of strength or you
Yes.
don't have any other backups or alternatives.
Yeah.
So I want to quickly sort of switch gears a little bit and sort of say that if the deal is not right, or if you are having to sell your soul
Yeah.
and you decide, I'm not going to do that, what are some other alternatives? I'm guessing pre-selling, or you could just, go a bit slower. Well,
Look, the only alternatives that you really have is to just slow things down. I mean, often capital is one of those things that you get to catapult the business. And if you don't have it, then the only option you have is to keep doing what you're doing.
Yes.
I've seen it said, and I saw it in an article again yesterday, revenue is the best form of capital that you'll ever have.
Yes.
So, I'm still very much of the mind that your business has to actually pay for itself. So you can go back to that. If you've got a business that is not paying for itself, that is draining money at a rate of knots, you really need to go back and look at the business model and say, well, is this business actually sustainable? Having said that, we see examples all the time of businesses like, and I'll use LinkedIn as an example, who I think it was the first 8 years did not have a revenue model, nor did they have a cent of revenue. That doesn't typically happen as much in some countries as it does in the US. So the US investors tend to be a little bit more au fait with the whole growing users and will worry about revenue as a secondary thing. Other countries are a lot more focused on having a really sustainable business first in terms of revenue before they look at injecting capital into a business.
Now, we've got a lot more questions, but I want to ask a bit about your personal experience,
Okay.
because with your current business, you've now raised capital 4 times.
That's right.
So tell us about how that journey has been for you, and why did you raise, at what point do you decide we need to raise more capital and go through the process again?
Okay, look, it's been a really huge learning experience. As you mentioned earlier, I've had 7 businesses. I've never had to raise money in any of them. In fact, when we started this business, I didn't even know that you could.
Yes.
I was of the mindset that if I wanted money, I had to go and get it from the bank.
Yeah.
And if I can just tell you a funny story, our first business, it wasn't called Workable. The previous incarnation was called something else. And we started, after about 18 months, we were marginally profitable. We started going to some tech events because it's a tech-based business. And the very first one we went to, I ran into somebody from the Commonwealth Bank, and they were running a women's pitching competition. And she said, you guys should go in that, because my co-founder and I are both women. And I said to her, what is a pitching competition? So we knew nothing about raising capital. It was interesting because we entered that competition. It was 2 weeks later. We prepared on the afternoon of it and we won it.
Wow.
And the prize was a trip to Silicon Valley, which was a life changer
Okay.
in terms of our business.
Well, I've got to ask
for
you
us.
about that. Tell us about that experience and what it was like to go there, and your background is as an accountant.
Yes.
So, and you had no idea. So I suppose it's really inspiring for anyone kind of watching this to sort of say that you're got to start somewhere.
Yeah.
So you did your pitch competition, you won that,
Yeah.
you went to Silicon Valley.
Yeah.
What happened next, and how did that whole world open up for you?
Well, it's interesting because being an accountant, when we started the business, and I think I said this before we went to air to you, I'm a fan of business. I'm not necessarily a fan of any specific sort of business.
Yeah.
So our business was started from a concept of frustration.
Yeah.
So both Ali, who's my co-founder, and myself were looking for work that fit around other things that we had.
Yeah.
So I had a son in school. I also had a couple of consulting clients, and I was looking for a bit more work. Ali.
To continue enjoying this presentation, download Bryn, the world's first business advisor in your pocket. To find out more, visit bryn.ai or search the App Store today.